Well, let's talk about the regional banking crisis first, because I think the market was beginning to think the crisis was probably over with the earlier problems of Silicon Valley Bank and also Signature Bank. But now with First Republic also needing to be taken over, worries that that is just going to roll on for a while. And I think that is something we have to keep an eye on. The depositors are getting very savvy about moving their deposits around, both to seek higher interest rates in this new higher interest rate environment, but also to seek safety. And so I think, because I think there could be no guarantee that we're not going to see further banks that come under pressure. And given that, I think the Fed is going to watch that very carefully. And that would, if this thing got significantly more serious, that would, I think, force the Fed's hand. Now, in terms of the economic data, I mean, the Fed says it's data dependent. Well, the Fed's always data dependent. I think it's kind of a silly term. They're always data dependent. There are going to be two employment reports before the next FOMC, and I believe there is now some strong signs that the economy is starting to slow, even if the labor market remains reasonably robust and the consumer. And by the same token, inflation is falling. My numbers suggest that inflation could easily be down to between 3 and 3.5% by the middle of the year, by which time, therefore, real interest rates are going to be over 1.5%. And that, I think, would give you a really good signal for the Fed to start to pause. Now, core inflation is going to be a bit higher, and of course, that's a concern. So I would be watching in terms of the real data, what happens in the labor market, what happens to the overall economy, but in particular, what happens, I think, to headline and core inflation. And those are the drivers. And I think the fact that the bond yields are lower tonight, and also the dollar is lower, is sort of telling you that investors believe there's going to be enough softness in the macro data and in the inflation rate to push the Fed to stop here. Although, as I've said earlier, I do not expect there to be a rate cut in 2023. I think that's a 2024 story. But that's, I think, what the Fed is going to be watching. It's going to be the banking situation and the economy and the inflation rate, of course.
Okay, so you preempted my question. I was going to ask you if you believe 2023 or 24. You've clearly said 2024. One very quick view, a view on risk assets, both US markets as well as maybe India as well, individually, or EMs in general.
Well, EM's been disappointing again, unfortunately. EM right now, although we're having a nice rally today, which I think is great, which is buy on the news, frankly, it does look like rates are now at the peak. I think the Fed is not going to raise rates again in this cycle. So that's going to be seen as good news. Now, it's still been disappointing. EM's up about 2% this year. Developed markets are up about 7.5%. So that's really been a disappointing performance. When markets rally, EM typically outperforms. The dollar's going down, although I think it goes down possibly a lot more. And I think what's going on here, I think it's been a second look at China, which of course is such a big part of the EM index, and I think that's been disappointing, and that's been a drag on the index. And some other big markets have not looked very good either. South Africa's been a good example. Latin America is doing quite well, although Brazil is weak. So there are a number of big markets that have pulled the index down. But I genuinely believe that any of these sell-offs we're getting here are a really big buying opportunity for equities, because I think rates are at their peak. If you ask me the question, I think rates have now peaked at the short end. You've got support from a lower bond yield and from a lower dollar. You've got inflation that is falling, albeit the core rate is falling more slowly. I think we will avoid a recession in the US. And obviously valuations have come down somewhat. So I think this is a real buying opportunity, and I'm positive. And although I'm a bit disappointed with the market's performance generally over the last 2 to 3 weeks, I think this is a good buying opportunity, not least because, as I say, it looks to me like the Fed is pretty much done with this monetary tightening as of this meeting today.